Most retirement planning tools make the same assumption. They say take your spending today, then increase it by inflation every year for the rest of your life. What if that's wrong? And more importantly, what if believing that leads you to save more than you need, retire later than you want, or spend less than you could actually afford to? JP Morgan just released a new retirement spending study using data from over 280,000 households. And what they found flips a lot of conventional thinking on its head. Today, I'm going to walk you through what JP Morgan calls the three new spending surprises and how they should shape the way you think about your retirement. Let's start with the biggest myth that your spending increases with inflation every year throughout retirement. That's not what the real world data shows. JP Morgan found that most retirees actually spend less as they age, not more. Their data shows that spending tends to peak in your early 60s and then decline gradually through your 70s and early 80s. Yes, healthcare does go up later in life, but this increased cost is more than offset by a reduction in spending in most other categories, making the overall trend a downward slope, not an upward climb. This is what they call the retirement spending curve. And it makes total sense if you think about it. In your 60s, you're traveling, golfing, trying new restaurants, maybe helping your kids or grandkids financially. But in your 70s and 80s, life naturally slows down. You travel less, your calendar is less packed, and often the biggest spending categories like housing and entertainment start to drop off. So if your plan is based on this idea that your spending needs to rise 3% every year no matter what, you could be overestimating by tens of thousands or even hundreds of thousands of dollars. In fact, JP Morgan found that for retirees with 250 to 750,000 in investable assets, the average inflation adjusted increase in spending is just 1.8% per year. That's already a full percentage point below general inflation, and that includes healthcare increases. So not only does this spending decline, but even the parts that go up don't rise as much as most plans assume. The reason this matters is because if you're planning based on flawed assumptions, you may think you need more saved than you really do. And that might delay your retirement by years or cause you to spend less than you could once you actually retire. For example, let's say that you're 50 years old today and expect to need $80,000 per year in today's dollars from your portfolio in retirement, not including other income sources. You want to retire at 65, so you inflate your expenses by 3% per year and arrive at $125,394 per year in future dollars. If you use 1.8% instead of 3%, that's only $104,775. Using the 4% rule, you'd need 25 times your expected withdrawal amount, or 3.125 million if you needed $125,000 per year, but only 2.6 million or so if you planned for the more likely 104,000. That could mean years of working longer based on false assumptions. To take it a step further, the 4% rule also assumes that you increase your withdrawals by inflation each year for 30 years once you retire. But if you also adjust that to 1.8%, as the study shows, you would only need about $1.7 million to support that spending amount throughout retirement. Full disclosure, this is just a quick example assuming your investments grow at 6% per year and you reach the end of your life with $0. So obviously everyone's goals will vary, but it does show the impact that a minor change in your spending assumptions can have over a 30 to 40 year retirement period. Now here's something that might surprise you. There's one phase where spending does actually jump, and that's right around the start of retirement. JP Morgan calls this the spending surge, and it mostly affects what they call partially retired households. These are people who reduce work hours or shift to part-time, while also starting to draw retirement income like Social Security or pensions. For this group, spending actually increases in the years right before and after retirement. And you know what categories see the biggest spike? Things like food and beverages, apparel, and healthcare. JP Morgan found that this group also tends to have more credit card debt and lower cash balances compared to those who fully retire all at once. This means they may be trying to make up for lost time, take long delayed trips, or simply enjoy a bit more freedom. But it also shows how important it is to plan for that surge window. Because if you underestimate what you'll spend in the first 2 to 3 years of retirement, it could throw off your entire withdrawal strategy, especially if you hit that window during a market downturn. Now you're dealing with spending pressure and sequence of returns risk. So let's recap for a second. First, overall retirement spending trends down, not up. Then right at the beginning of retirement, some people experience a surge in spending. Now here's the third piece. Spending in retirement is volatile, meaning it jumps around more than most people expect. JP Morgan's study found that 6 in 10 retirees had years where their spending changed by 20% or more, up or down, compared to the year before. And that wasn't just in their 60s. Even retirees in their late 70s saw this level of variation as well. So the idea that you can just draw 4% of your account balance each year and increase it for inflation and call it a day, it's a nice starting point, but it's way too rigid for how real life works. Retirees need flexibility because one year you might need to replace your roof, take a family cruise, or help with a wedding. The next year might be quiet and uneventful. If your retirement income strategy doesn't account for those ups and downs, you could end up withdrawing too much in a bad year or holding back too much in a good one. So here's the big takeaway. Most people think that retirement spending looks like a steady uphill climb, but it's more like a hill that peaks in your early 60s, dips gently through your 70s, and might have a bump or two in your 80s or 90s, especially for healthcare or long term care. The assumptions baked into many financial plans are just too simplistic. They assume constant inflation, level withdrawals, and stable lifestyles. But we all know life doesn't work that way. Retirement planning should be dynamic. It should adapt to the reality of how your spending will actually change, with flexibility in both your withdrawal strategy and your income sources. If you're interested in seeing how we incorporate these spending observations into retirement plans with our clients, you can watch this video next, or you can always visit our website to learn more about working with us. Thanks for tuning in, subscribe to the channel for any future videos, and we will see you in the next one.